Welcome to the channel. Thank you for coming again. And please note that all this information is for educational purposes and does not constitute investment advice. If you are copy trading, you're a moron and you deserve to lose all your money. So, with that said, today's stock is a company called Mastec. And as we pull up the stock here, first thing you can see is that the company has been on a pretty steep downhill trajectory for quite some time, since August, when problems started to happen. So in August, they started advising the market on certain issues that the company was running into, and over the summer and also September, October, there was a general market sell-off. So we can see here taking place all the way until here, where they reported earnings, and you can see where the stock is trading at 58. Pretty steep gap down move that reached below the $45 mark. So you have a stock that has, in the space of a few months, gone from 120 to just over 40. So that's a very, very significant decrease. Now, in terms of the stock itself, if we compare that to its peers, it was one of the lowest valuations compared to some of its competitors. But what happened here was that the EPS missed big time, and we can see here, if we go to the snapshots, earnings history, you can see right here. So big miss, 48% miss. That's big. That's definitely a big surprise, and market didn't take it well, of course. So what exactly happened? Well, this company has 4 different segments that they do business in: clean energy, oil and gas, power, and communications. And clean energy was the greatest problem. So they experienced continued delays in this segment in terms of project start dates. And the margins remain pressured by the cost to maintain resources for the anticipated ramp in activity. Now, they also have said during the earnings call that they expect a lower level of activity in the segment in the fourth quarter of 2023. So that signals that it is not expected that things are getting better anytime soon for this segment. Will those issues persist? Well, we'll have to have a look into that. I don't think it's something that can be fixed overnight, so definitely we have to keep an eye on what is happening on those. But let's look at the other segments as well. So on oil and gas, they had a slower than expected ramp in construction of a project. They have massive legal challenges with that, but they still think that the segment revenue is going to remain intact for the year. Okay, fair enough. We'll have to see what's happening in that sector as well. Maybe is the oil price important for them? Okay. Next is the 2 sectors, power and communication. So in those, they experienced lower than expected revenue due to consumer deferral of previously planned activity. And they had delays driven by significantly higher financing costs and annual budgetary limitations. So the company expects reduced activity to continue through Q4. Again, not getting better anytime soon. And only when budgets are replenished, then perhaps their expectation is that it's get better. Something that they highlighted during the earnings call is that they have been awarded 300 million for each of the 2 sectors, so that's about 600 million. But if you think about it, that's meaningless because the revenue of the company is 12 billion, right? So that is just very tiny. It's like 5% of the revenue. I haven't, yeah, I think something around that is very small. So it's definitely not significant, especially bearing in mind that the revenue of the company has been actually okay, but it's the earnings that really missed, as we have seen just now. Now, let's have a look at the financials. If we look here, let's look at the highlights. We can see that the financials have deteriorated. So again, even though revenue has improved, so we've gone from almost 10 billion to 11.7. That's getting better, yeah, okay, that's good. But even with that, the gross profit margin has decreased over the last few years quite consistently, actually, is in a downward trajectory. The EBITDA margin as well, on a consistent downhill trajectory, and net income, which is not only down year on year, but it's now negative. So definitely those numbers are not good at all. And also quite interesting that capex, 200 million versus cash flow from operations at 430. So you got capex is almost half of their cash flow from operations. Compare that with, for example, previous years, where yes, it was a similar amount of capex, but the cash from operations was a lot larger. So those things are definitely important. Now, what else has been happening? Well, when you look at these numbers, right, you definitely want to understand what the CFO is thinking about this company. And his remarks about the situation was that while the revised earnings outlook will prevent them from reaching their 2.5 times net debt leverage goal by the end of 2023, they think that this level is achievable next year in 2024. At the moment, their current debt to equity ratio is just below 120%. And they want to get to that 2.5 times net debt leverage next year. Well, we'll have to keep an eye on what's happening with interest rates because that is quite important for them. I came across because this is a company that is rated by by ratings agencies, and I came across what Fitch Ratings is saying about them. So we've seen that they have looked at this company over the years quite regularly with BBB minus. I think that's below investment grade. Can't remember, but it's not great. And they have consistently kept that going. Last time they reviewed this was at the end of last year. So it is possible that they are due for a review, and I can't see how things have gotten better or even stayed the same compared to last year. So there could be another downgrade from Fitch coming sooner rather than later. And as a matter of fact, it has happened already at S&P. So there's an article here, fairly recent, 6th of November, where S&P revised their outlook to negative. And some of the reasons why they allude that to is what we have already talked about. The earnings revisions, because they had to, obviously, after such a massive miss, they revised earnings. So they're concerned about their ability to achieve the preliminary guidance and, of course, reduce leverage. They allude to reasons why we have come to this point, which is 2 years of aggressive acquisitions. So that led to their leverage profile to deteriorate substantially. And that comes back to the comments that we talked about earlier from the CFO. They also saw as well weakened margins to the mid 7% area compared to the expectations of 9%. And they think as well that revenue shortfalls stem from optimistic focus on project timing. So yeah, it's really not looking great at all. There's additional headwinds like a company that they acquired called Infrastructure and Energy Alternatives. They think that with the integration of this portfolio, the company is facing ongoing headwinds because of their limited access to tax credits through the Inflation Reduction Act. So S&P's view on this is that timing around the resolution is unclear and will limit the company's ability to grow the clean energy and infrastructure revenue base, which is about 33% of their revenue. That's quite significant. At the same time, this drag is going to put disproportionate pressure on margins due to strained cost absorption. Okay, and that leads to the communications and power delivery segments, which is 28 and 22% respectively, to be pressured by delayed capex due to high funding costs. We also have comments from S&P advising that they think that changes in their revenue mix will substantially lower contribution from high margin oil and gas segment, will weigh on their profitability, and that their reduced earnings and rising interest expense will further hamper its cash flows in 2024. Now here's some part that is very, very important. Their debt structure is primarily comprised by variable rate debt. So definitely whatever the Fed is doing is going to impact significantly the company, right? But if we enter, you may well think that we are entering a higher for longer stage. Well, that is not going to be good for the company at all. Because at present, S&P is estimating that the cost of financing the company is going to increase in 2024, after obviously increasing in 2023, and remain high over the next couple of years. That's their expectation. S&P's expectation is that because we're going to enter a higher for longer interest rate environment, that's what's going to happen to the company. And the underperformance and lack of interest rate hedges, this is also a very important thing, will continue to constrain the cash conversion through 2024. So it's not really a bit of well, will that happen? Well, yes, because they're not hedging their interest rate exposure. So if we do stay in a higher for longer environment, that's not going to be good for the company for sure. Really, the report throws a lot into the company. There's even more remarks from S&P advising that the additional financing costs could put incremental pressure on cash flows if its earnings trajectory does not reverse, and that they could even lower their rating even more over the next 12 months if the company cannot execute on growth strategy and margin improvement. So they set a few conditions for that. But one very important thing that they mentioned is that a shift in the company's financial policy that could include prioritizing share repurchases or acquisitions of a debt repayment could also result in a downgrade, right? So you have that toolbox that has been very popular over the last few years, and specifically for this company with acquisitions out the window. So they have little options really, and if that if that interest rate environment does materialize, then for sure it's not going to be an easy battle for them. So we've seen all that, and yet we look at what the analysts are doing on this company, and they have 10 analysts saying that the stock's gonna buy, like seriously, after going so much. So these expectations are probably just outdated, with to hold 0 sales, which I find very hard to believe. So the question we gotta ask ourselves is, well, why did they not downgrade the stock? And they may do. Maybe it's just they're catching up, and we could see a string of analysts coming up with new price targets and new downgrades very soon. And like I said, Fitch could also do the same with their debt repayment profile. So really, not a good picture at all. So with that said, let's go back to the chart. We got short interest rising slowly over the summer. So some people definitely saw this coming before it all started. But now that is materialized, we are at around 4.60%, which is a significant increase from where we were before. So the 52-week low, which we reached just recently after that EPS miss, is at 44.65 US dollars. And the $50 level has been historically quite a strong resistance and support level. We can see that here, actually, when the stock falls off a cliff, gets to around 48 down to 44. That's exactly when we reached it, to go back up, probably after the news on CPI and so on, and then going back to 54. So it's bounced back after reaching that 50 level. That 50 level we can see here, for example, if we go back 10 years, we can see that that has historically been, let's do it here, yeah, that's historically been quite strong support. Look at here, when it was ranging for quite some time, and after the start of the pandemic, right here, how it broke here, stayed for a while, and then took off. So I think it's very likely that we're gonna stay in this 50 support level for maybe a few days, possibly a few weeks. But likely, I would say the stock is gonna come down, because look at the next 12 months PE. Currently at a high. It's one of the highest that it's had this year. What did the stock when it reached those levels? It dropped here when we got to that 24, 25 times. What did the stock do? Go down. Here as well. We got here. What did the stock do? Go down. And this pattern actually repeats through history. If we go a little bit further back in time, the stock here got around those levels. What did the stock do? Go down. And here as well. Next 12 months PE gets to those levels and the stock goes down. That's exactly where we are at the moment. So I think there could be significant momentum, maybe not in the immediate term. And we gotta bear in mind that we are going through some changes with interest rates. Maybe, who knows, the Fed may do come with cuts earlier than expected. We also have the market overall going up. So I'm not saying that this stock is going to continue going in this straight trajectory for the time being, but for sure in the medium term, I think it'll keep going down. So something you could do, or better said, my Likely strategy when looking at this is probably a put calendar spread. So that's something I'm gonna be definitely looking into. So that's it for today. Hope you have enjoyed that, and feel free to leave some comments if you like. Speak soon. Bye.